Usually when we think about a map of the world, there's this expectation of permanence.
Right.
Like you look at a globe, the continents are exactly where you left them. And you get this comforting sense that the fundamental shape of things isn't going to just, suddenly change overnight.
Which, I mean, is a perfectly natural way to view geology, but it's an incredibly dangerous way to view the global economy.
Yeah.
Because if you look at the financial and technological landscape right now, in March of 2026, those tectonic plates haven't just shifted. They've completely fractured and reformed.
The old maps are actively leading people off a cliff at this point.
Exactly.
Well, welcome to the deep dive. The global investment playbook has been entirely rewritten, and today we're taking a massive, really comprehensive report titled The Most Compelling Investment Concepts for 2026 to 2031, and we're using it to map out exactly where the world is heading over the next 5 years.
And it's a lot of ground to cover.
Oh, definitely. We're tearing into the physical realities of artificial intelligence, the modernization of our power grids, the explosion of the silver economy, and why Wall Street is suddenly trying to put data centers into orbit.
Literally into orbit.
Yeah. And more importantly, we're distilling what all these massive macro shifts mean for you, for your career trajectory, your daily cost of living, and, your retirement savings.
Which is what really matters at the end of the day.
Okay, let's unpack this. Because a transformation this huge doesn't just start with the new phone release. Where is the actual ground zero for this shift?
Well, to understand the specific booms we're seeing in technology or energy right now, we first have to look at the massive geopolitical tectonic plates shifting underneath us.
Right.
You really can't understand a 2026 technology without understanding the foundational reality of a 2026 supply chain. We're looking at these innovations in a world that has, frankly, fundamentally changed how it conducts global business.
So we are officially out of the era of easy and cheap.
Oh, completely. The macroeconomic data from the source material paints a very specific picture here. The global economy is actually seeing resilient, moderate growth.
Sure.
The IMF projects global GDP growth at 3.3% for this year, 2026, and inflation is actually cooling globally to around 2.8%.
Which sounds pretty good on the surface.
It does, but capital is no longer cheap. The U.S. 10-year Treasury yield is hovering high, right around 4.26%.
Wow.
Yeah. And that whole post-Cold War era of high-trust, frictionless, heavily globalized supply chains, that architecture has been completely dismantled.
Right. It's being replaced by what they call friendshoring.
Exactly.
Nations and corporations are just aggressively prioritizing national security and physical resilience over pure economic efficiency.
They have to.
Yeah, we're watching this massive U.S. and China tech and semiconductor war redraw the global landscape in real time through, aggressive tariffs and strict export controls.
It's everywhere.
It's like, well, think of it like the global economy is switching from buying groceries at a massive, incredibly cheap superstore to growing its own food in a fortified high-tech greenhouse.
That's a great way to put it.
Right. It's much safer and far more resilient to shocks, but man, it requires way more capital up front to build the greenhouse.
If we connect this to the bigger picture, that upfront capital requirement is exactly why multinational companies are suddenly facing much higher operating costs.
Right.
When you build parallel supply chains just to have a backup in case of geopolitical conflict, your profit margins naturally shrink. You're basically paying for redundancy.
Which makes sense, but it hurts the bottom line.
It does. But this also explains why sectors tied directly to national security, domestic technology, and resource independence are seeing just an unprecedented influx of government support and private capital.
The money is following the security.
Exactly. The strategic high ground has fundamentally relocated.
And that leads us, I think, to the most contested piece of real estate on the board right now. Artificial intelligence.
Oh, absolutely.
What completely shifted my perspective in this report is how it frames AI. Because we're so conditioned to think of AI as just software, right?
Just code in the cloud.
Exactly. Invisible code floating around generating text or maybe creating a funny image. But the report connects that geopolitical drive for technological supremacy directly to the physical build-out of AI.
Which is massive.
Yeah, it isn't just code. It requires staggering amounts of concrete, steel, and silicon.
We are squarely in the middle of an AI infrastructure supercycle right now. The physical footprint required to run this future is just monumental.
How monumental are we talking?
Well, according to the report, global data center capacity is projected to double, reaching 200 gigawatts by 2030.
Whoa.
And to physically build that out, we are looking at $3 trillion in real estate and IT investment over the next few years.
$3 trillion just to build the physical warehouses and stack the servers.
$3 trillion. And the nature of what those servers are doing is shifting as we speak.
How so?
Well, for the past few years, the entire focus was on training AI models. You feed a massive cluster of computers the entire internet so it can learn patterns.
Right, the learning phase.
Exactly. And you can do that in the middle of a desert if you want, because it doesn't need to be instantaneous. But the workload is shifting heavily to what's called inference.
Inference.
Yeah. Inference is when you actually ask the AI a question or have it perform a task live. The report projects that by 2030, inference will make up 50% of all data center traffic.
Which requires a totally different physical setup.
Completely different.
Like training is like studying for a massive exam for months in a remote library, right? It takes time, but you can do it isolated anywhere.
Sure.
But inference is taking the test live.
Yeah.
You need the answer instantly. Which means those inference data centers have to be geographically distributed and physically closer to the end user to avoid network lag.
Precisely. You need incredibly fast, low-latency connections for inference. But let's look at the financials behind this build-out. Data center real estate investment trusts, or REITs, they posted a 21.3% year-over-year growth in 2025.
That's huge growth.
It is. And you also have semiconductor juggernauts like TSMC planning to spend between $52 and $56 billion in capital expenditures just in 2026 alone.
Just in 1 year.
1 year. They are racing to produce ultra-advanced 2-nanometer chips, because those chips offer the computational efficiency required to handle these massive inference workloads.
Okay, wait, hold on. Let me push back on this massive spending spree for a second.
Sure.
We are dropping $3 trillion on physical real estate, server racks, and silicon, just so autonomous AI agents can write our emails faster. Or summarize a PDF.
You know how it sounds.
Like, are we absolutely sure the return on investment actually justifies this massive physical footprint? Because looking at those numbers, I mean, it sounds like an infrastructure bubble just waiting to pop.
It's a vital question. And it's one the market is actively stress testing right now. But the source material provides data on the actual value being captured, and it goes far beyond summarizing PDFs.
Okay, so what's the actual value?
The report focuses on autonomous agentic AI. These are AI systems capable of executing complex, multi-step tasks in the physical and digital world without a human approving every single step.
Oh, wow.
Yeah. Early adopters and high-performing companies are currently seeing a 4.5x ROI on these tech investments.
Well, 4.5x ROI on what exactly? Like, are they just laying off customer service reps, or is this technology doing something fundamentally new?
They're deploying agentic AI to fundamentally restructure complex enterprise workflows.
Give me an example.
We're talking about AI agents autonomously rerouting global logistics ships in real time to avoid a port strike, or analyzing thousands of patient scans to completely revolutionize healthcare diagnostics and triage.
Okay, so real, tangible world impacts.
Exactly. The productivity gains are materializing in ways that directly impact corporate bottom lines. The infrastructure boom is literally just racing to catch up with the proven commercial value.
Okay, so the demand is real and the buildings are going up. But this brings us to a massive, glaring bottleneck in this whole operation.
The power problem.
Exactly. We're basically trying to plug a highly advanced supercomputer into a wall outlet from the 1970s.
It's a great analogy.
You cannot run 200 gigawatts of AI data centers, not to mention a booming electric vehicle market, on our current aging power grid. This massive digital boom is violently colliding with very rigid physical energy constraints.
The grid just wasn't built for this.
No. Think about your own local utility grid when everyone turns on their air conditioning in August. Now add a localized inference data center to that load.
What's fascinating here is the deep irony of the situation. We envision this incredibly clean, highly digital, AI-driven future, but to actually construct it, we're relying heavier than ever on some of the oldest, dirtiest, and most physically demanding industries on Earth.
Heavy infrastructure, utilities, mining.
Exactly. The grid upgrades alone are a monumental undertaking. The European Commission estimates that 584 billion euros is needed for grid capital expenditures by 2030.
Wow.
And that is just to upgrade the wires, transformers, and substations so they literally don't melt under the new load.
And then you have the battery equation on top of that.
Right.
because the grid needs storage to balance out renewable energy, and the electric vehicle market is still scaling. The report projects global battery demand hitting 4.7 terawatt hours by 2030.
Which is a staggering amount of material.
Yeah, to physically manufacture those batteries, global lithium demand is projected to hit 2.0 million tons right now in 2026.
And we're also seeing a rapid scale-up in alternative fuels for heavy industries that can't simply be electrified with a battery, things like steel manufacturing or long-haul shipping.
Because you can't just put a battery in a cargo ship.
Exactly. So hydrogen is scaling fast for those hard-to-abate sectors. China's electrolyzer capacity, which is used to produce green hydrogen, is expected to expand eightfold by 2027.
Eightfold.
Yeah. And we are also seeing voluntary carbon markets, which help fund these massive energy transitions, potentially reaching $25 billion by 2030.
Which brings us right back to the geopolitical tension we started with. Because if we need 2.0 million tons of lithium, and we need staggering amounts of rare earth minerals and copper to build these new grid transformers, who controls those resources?
That is the defining security question of the decade.
Yeah.
The U.S. and China tensions have brutally exposed Western vulnerabilities in the supply chains for rare earths and copper. Historically, the refining and processing of these critical minerals was heavily concentrated in China.
Right.
Now we're seeing sweeping government interventions from the U.S., Japan, Australia, and Europe to secure allied supply chains. They're treating critical minerals the exact same way they treated crude oil in the 1970s.
That's a huge shift.
Strategic resource security is now a core investment theme. If your country cannot secure the copper and the lithium, you cannot build the data centers, and you forfeit the AI race.
The geopolitical leverage has moved from oil fields to copper mines.
Essentially, yes.
So we're spending trillions upgrading our digital brains and trillions overhauling our physical energy and mining infrastructure to power them. But the report highlights another massive limitation we're running into.
The human element.
Right. We're physically constrained by energy, but we're also physically constrained by human labor. The global population is fundamentally changing right now.
We are living through a demographic earthquake, and 2026 happens to be the epicenter.
Wow.
The source material points out that 2026 marks the absolute peak year for baby boomer retirements globally.
Which is fueling what the report calls the silver economy.
Yes.
We're talking about an unprecedented generational wealth transfer. By 2030, global seniors are projected to spend $8 trillion annually.
$8 trillion.
It's completely reshaping consumer spending. Like, if you've looked at the cost of your parents' care recently or projected your own, you know exactly what this looks like.
It's incredibly expensive.
Yeah. It's driving massive, sustained demand for healthcare REITs, think specialized senior living facilities and medical office buildings, as well as financial products designed specifically for longevity hedging, like annuities.
But as this massive aging population demands more complex medical care, they are colliding with a severe human capital shortage.
Not enough workers.
Exactly. There simply aren't enough young people entering the workforce to provide the hands-on human-to-human care required by an aging demographic. That labor squeeze is going to place massive fiscal pressure on healthcare systems globally.
Here's where it gets really interesting, because right on cue, as we hit this demographic crisis, the biotechnology market is experiencing an absolute explosion.
It is.
The report projects the global biotech market will nearly double, growing from $2.42 trillion in 2026 to $4.41 trillion by 2031.
That's incredible growth.
Right. So does this mean AI's biggest tangible impact over the next 5 years won't actually be in enterprise software or automated logistics, but in keeping you and me healthier for longer to offset that labor shortage?
It's a profound collision of two massive trends. You have a demographic that desperately needs precision medicine, and you have AI arriving exactly on time to provide it.
It's almost too perfect.
Well, AI is utterly revolutionizing drug discovery. Historically, finding a new drug involved years of physical trial and error in a wet lab.
Right.
Now, AI can model complex protein structures and run millions of molecular simulations virtually in a matter of days. The report notes that by 2024, over 75 AI-derived molecules had already entered clinical trials.
So we're really moving away from the conventional one-size-fits-all drug manufacturing model.
We are moving toward a highly personalized, AI-enabled precision medicine ecosystem. Gene therapies for rare diseases are finally validating their commercial pathways.
That's amazing.
Yeah, AI is identifying the exact molecular target, and biotech is delivering the customized therapy. AI might not be able to physically bathe an elderly patient. That hands-on care is incredibly difficult to automate, but it can rapidly discover the drug that prevents their cognitive decline in the first place.
Which completely alters the burden on the healthcare system.
Exactly.
Okay, so Earth's surface is getting incredibly crowded with aging populations requiring massive resources. Our power grids are maxed out trying to run these data centers. And our geopolitical borders are tightening, making supply chains wildly expensive.
It's a lot of friction.
So where does capital and innovation go when the surface of the Earth gets too complicated and constrained? It goes upward and it goes inward into entirely new financial plumbing.
Let's start with upward. The space economy is no longer a speculative science fiction play. It is a mature, highly investable sector.
Okay.
And interestingly, much like the tech sector, it's heavily anchored by defense and national sovereignty. The real predictability in space revenues right now is coming from governments that urgently need secure, resilient satellite communications and space situational awareness.
But it goes beyond defense and just, blanketing the globe with broadband satellites.
Absolutely.
The detail from the report that completely stopped me in my tracks was space-based data centers. They are actively testing in-orbit compute, literally putting the servers in space.
When you think about the severe power and cooling constraints we just discussed down here on Earth, it actually starts to make practical engineering sense.
Putting servers in space makes sense.
Hear me out. Putting a data center in the freezing vacuum of space, powered directly by unfiltered, constant solar energy, completely circumvents the terrestrial grid bottlenecks.
Okay, wow.
Assuming, of course, you can solve the launch costs. And thanks to private companies currently dominating the launch cadence and pioneering reusable rockets, the cost per kilogram to orbit is dropping to a level where in-orbit compute is financially viable.
That solves the physical constraints. But capital is also moving inward to bypass the friction of our traditional financial system.
Right, tokenization.
Yeah. The report highlights the explosion of digital assets and tokenization. And to be clear, we are not talking about trading volatile meme coins here.
No, not at all.
This is about taking real-world assets, a piece of commercial real estate, private credit, government bonds, and turning them into digital tokens on a blockchain.
Exactly.
Like if you own an office building, instead of taking months to sell the whole thing through lawyers and banks, you chop the ownership into digital shares that can be instantly traded globally 24/7.
And the scale of this transition is finally arriving. The report notes that the tokenization market is breaking the $100 billion barrier this year in 2026.
$100 billion.
And it's accelerating toward $418 billion by 2030. What we're witnessing is the deep structural convergence of traditional finance, or TradFi, and decentralized finance, DeFi.
Emerging.
Yeah. You have massive legacy institutions deeply involved in this plumbing. JP Morgan is operating their own USD deposit token to settle transactions instantly.
Wow.
Over 130 countries are actively piloting central bank digital currencies. Unlocking liquidity in private credit or real estate fundamentally changes how massive pension funds operate, which, by the way, directly impacts the yields on average retirement accounts.
Right. And while the financial plumbing gets rebuilt on blockchains, entire nations are leapfrogging the old industrial models entirely.
Emerging markets.
Yes. Emerging markets are surging. India is projected to hit 6.5% GDP growth in 2026.
That's massive growth.
And they aren't just focusing on low-cost textile manufacturing anymore. They're jumping straight into semiconductors, biopharma, and advanced digital economies.
Right.
So what does this all mean? We're moving server farms into orbit to catch unfiltered solar power. We're moving bank deposits onto blockchains to avoid legacy friction. And we're shifting advanced manufacturing to India. It's like we are simultaneously building out the sci-fi future in the stars and rewiring the absolute deepest plumbing of Wall Street.
This raises an important question regarding how we govern this new reality.
Regulation.
Exactly. The potential of the space economy and global blockchain tokenization is virtually limitless. But by their very nature, a satellite orbit or a decentralized blockchain does not care about physical borders.
Right.
They require massive, seamless international coordination, which is incredibly difficult to achieve in the highly fragmented, protectionist, friendshoring world we established at the very beginning of this deep dive.
Yeah, the greenhouse economy.
Right. The legal fragmentation, having different regulatory rules for tokens in the European Union versus the United States, or escalating disputes over satellite spectrums is the single biggest risk to these futuristic sectors.
It always comes back to the map, tectonic plates. Let's recap this incredible journey through the report.
Let's do it.
We started with a fractured global economy that is willingly paying a premium for security over efficiency. That geopolitical tension is driving an arms race for AI supremacy, which has triggered a $3 trillion physical infrastructure boom.
Right.
But those AI agents require massive amounts of electricity, forcing a total overhaul of our aging grids and a desperate scramble to secure critical minerals like lithium and copper.
It's all connected.
Yeah. And meanwhile, our human demographic is peaking, creating an $8 trillion silver economy that relies heavily on AI-driven biotech to keep us healthy amidst a severe labor shortage.
Right.
And finally, to escape the physical constraints of our borders and our power grids, we're literally testing data centers in orbit and putting our financial assets on digital blockchains.
It's just a breathtaking amount of structural change compressed into a very tight 5-year window.
It really is.
You simply cannot navigate the investments or the career paths of the next 5 years if you're still looking at the map from 2019.
Absolutely. And to you, listening right now, the report makes it incredibly clear that these aren't just abstract themes for billionaire hedge fund managers to trade on.
Not at all.
These are the macro forces that will directly dictate the rising cost of your local electricity bill, the type of precision medical treatments your family will receive, and the growth of your retirement accounts over the next 5 years.
You are living inside this rewritten playbook right now.
You all are. Which brings me to one final lingering thought from the source material. We spent a lot of time discussing the physical investments, the concrete data centers, the copper wiring, the grid transformers.
The hard assets.
Right. But the report touches on how AI is already actively reshaping our human labor markets. We're seeing tentative evidence right now of slowed hiring for younger workers in highly exposed roles, like entry-level coding and data entry.
It's starting to show in the data?
Yeah. So I want to leave you with this. If autonomous AI agents are taking over complex logistics and our entire physical world is being restructured by algorithms demanding extreme amounts of energy to run, well, what exactly will the uniquely human job description look like when we reach 2031? When you wake up and the map is shifted once again, what is your role in that fortified high-tech greenhouse? Something to think about. Until next time.